Hi, this is Eric Schleien. You are listening to the Intelligent Investing Podcast, and today we have back on Jeremy Raper. Jeremy, welcome back onto the show.
Hey, Eric. Thanks for having me. Good to see you.
It's my pleasure. We've had quite an interesting ride the last few months since you've been on. It seems like every time you come on, there's been some really interesting ride in either the market or in the securities you've talked about. So, maybe next time you come on, the markets will have been down 80%, and we'll talk about some weird thing then. So who knows? Anyway, welcome back.
Yeah, thanks for having me. Yeah, I think last time I came on was the end of March, was it?
Yeah, it was right when everything was a total shit show.
Exactly. So we did the coronavirus investing series.
Yeah.
Back in March. So, I mean, not to check the scorecard too much, but
you know what, Jeremy? I think we deserve to check the scorecard with some of the stuff you have brought up.
Yeah. Okay. So I mean, look, obviously the whole market's ripped back, so there's been a huge tailwind there. But we talked about AirCap in mid-March, which is, stock would have been, I don't know, near the lows, let's say 15 to 20. The stock's now in the mid-30s. Qantas Airways, we talked about on March 20th, that the stock would have been about 220, 230, something like that. The stock's now 450. Merger Arb, I think that was Tiffany's, that bounced quickly back, so that worked out. Then it obviously came off again, but now it bounced back. Then on March 27th, I think we discussed two gold stocks, in particular DRD Gold. That stock's doubled, and Polyus Gold is up about 60%, so those both worked. Gold has done okay, but obviously it's not up anything like that. And then obviously the kind of fan favorite, judging from what we've talked about offline, was GAN PLC. So we did another deep dive on that March 30th.
Not only is it a fan favorite, but Dave Portnoy now owns GAN.
I saw that. Davey Day Trader. Davey Day Trader for the win.
He's so funny. Have you watched his pizza reviews?
I saw one of them. It was hilarious. He walked up to the pizza store and he's like, he took a bite and he said, "Look, I only give it one bite." And he's like, "I'll be honest with you, I'm going to eat this whole thing in about 30 seconds." I was like, so true.
He's
so
true. Good. He's so good. I think it's funny though. People take him seriously. Like he's just like trolling people, right? He doesn't take his day trading.
Yeah, totally. I mean,
I watched him on CNBC. He did this interview, and I forgot who was interviewing him. It was just a professional woman on CNBC, and she goes, "So how's your day trading been going?" He goes, "It's been going great. I'm a really good day trader." And she goes, "Well, the number's pretty, deep in the red there." And he goes, "Well, no, that number's meaningless. Don't look at that number. Just look at that position right there where I've made a lot of money."
Yeah, I mean, he definitely knows how to sell himself. I mean, he's just a brilliant marketer, right?
He's hilarious, yeah.
It's free marketing for his new venture with Penn Gaming, right? So
I'm sure he is disappointed that Warren Buffett didn't respond to because that's that's what he wanted. He wanted Warren Buffett to not get it and to respond, and then to get more publicity. But
Buffett probably thinks he's funny.
I'm sure.
But
anyway,
yeah, so going back to GAN. Yeah. So just to remind everyone, this was the basically the online gambling software play that was listed on the AIM exchange in London, and there was the fundamental tailwind, but also the relisting tailwind. So I think we spoke about it when it was still listed in London, and I was kind of pretty bullish on the opportunity and the technicals.
Yep.
And then the stock's up like 4 times or something, maybe more. I mean, look, we were talking about it before. I didn't catch quite all the ride because I cut it maybe a month too early. But
right. If you had bottom ticked it to today, it's up over 900% now.
Exactly, and some of us on this podcast did that. Congrats. But in any case, it's been a huge winner. And then on April 1st, we also talked about some Japanese hotel REITs, which, look, these have not quite doubled. They're maybe up 50% each, so they've done well. But again, more catching the broader market kind of bounce there. So,
right.
Look, a lot of this stuff has kind of moved a lot more than the market. It's obviously moved a lot as well. And that's why we're looking further afield today. To kind of greener pastures where a lot of these US listed stocks now, or the mainstream stocks are, let's not say fully valued because who knows, but the low hanging fruit's definitely gone from a lot of things. So
yeah, I mean GAN I wouldn't certainly say is not low hanging fruit anymore. It was low hanging fruit when we talked about it last time.
That's right.
It was ridiculous.
So now we're going to talk about something that I think is equally ridiculous, or even actually more ridiculous.
Jeremy, before you do that, I know you don't own GAN anymore, but I think it has become so popular in the investment world. I think it is worth maybe just discussing their last quarter.
Okay.
I mean, I'd like to just hear your view on sort of the future of the company. You know, any thoughts you had of the last quarter before we move on.
Sure. I mean, look, I don't want to be too much of a downer.
Yeah, no, please.
Fine. It was fine. It was nothing. I mean, look, they didn't raise guidance. They didn't blow guidance away. The number came in basically exactly where they said the number would before they listed in the US, which, given the run the stock has had, I thought was slightly disappointing. But they said all the right things on the conference call, right? They're winning a bunch of new clients. They said they have more business than they can handle, so they have to be judicious.
It wouldn't surprise me though if they do raise guidance for next quarter. That would not.
Of course. They're going to raise guidance next quarter. The post-corona period has been, so obviously the first quarter was end of March, right? So
right.
The post-corona period was when, online gaming and gambling really kicked off. So look, I think they print much higher than 40 million for the full year revs, but look where the market cap is now, right? This thing, when we discussed this in March, this thing was trading at 3.5 times revs, right? Now this thing is trading at
it got down almost to about 2 times rev.
Yeah, it got back down to 2 times in the crash, and then it bounced from there. And I was kind of bigging it up, given that we were discussing business has been cut in half, and the actual fundamentals are much stronger because everyone's gambling online now. So look, I could not be more bullish on the fundamentals. At the same time, the stock is up, as you said, almost 9x from the lows. Like, what can you say? The market is, and also, by the way, this is now going to be entered into the Russell 2000. There's a lot of buying front running that move, and it's just not an undercovered gem anymore. I mean, There's nothing. It's not really a criticism of the company. It's just I loved it at 2 times revenues. I thought it was good value at 4 times revenues, and I sold it at 10 times revenues. And now it's trading at 13 times revenues, whatever it is. But
it's not the worst problem in the world to have. Let's put it that way.
Exactly. You know me. I'm more of a value bent. My strategy is more value oriented. So I try to find fresher pastures, which hopefully we can cover today.
Well, there's many, and even in the realm of value, there's many different ways to skin a cat. I mean, you could say Peter Lynch was a value guy, and he liked to hold things to find hunter bagger. So.
That's right. I mean, on a 5-year view, I'm sure GAN will be higher. It's just maybe in 6 months it's lower and we can revisit it, or, there'll be bumps along the way and it'll be worth revisiting. But yeah, I just happened to find something that I thought was far more compelling than GAN at its current price, and, much earlier in its growth trajectory, actually. And that's what we're going to talk about today.
All right. Sounds good. And by the way, you are doing a paid newsletter now, right, too?
That's right. So I turned my blog into a paid research service. It's called Raper Capital Pro. I mean, not to focus on that too much, but
no, I think you offer something valuable. It's worth sharing about.
Yeah,
we have a lot of listeners, so there might be some that are interested.
Yeah, I mean, sure. So if you go to rapercapital.com, you can obviously check out my blog. Everything before May is still in the public domain. So essentially, it's a continuation of what I was doing. That is, using my credit-based approach, which we've talked about before, to find undervalued stocks and obviously shorts as well, and kind of profiling what I think are really interesting off the beaten path kind of undercovered securities through that lens.
Yeah.
So what we'll talk about today, a company called Endor. I profiled that on my site a few weeks ago. Obviously exclusive for subscribers, and it seems like it was well received by the market. And we can talk about that, but obviously I try to go across the map, so to speak, wherever the most interesting opportunities are, using my network and obviously using my my own method to kind of find undercover companies. So
well, I respect that you spend a lot of time doing your own research, so I don't want you to be giving away everything on here, but let's talk about Endor if you're comfortable doing that.
Yeah, for sure. So I'm not going to give away all the numbers or all the the quantitative modeling which comes with the service, but just to kind of profile the idea.
Yeah, please.
If people are interested, they can follow up on the site, and obviously there's a huge amount more of information there.
Isn't it funny? I do want to say though, it is funny how people, because I have gotten this before, right? Where you spend 100 hours on a company, right? Or maybe more, right? Over over the accumulation of a few months. And then someone's like, so can you just send me all your notes for it? And I'm like, dude, like, really? And I get it sometimes, but it's just like, I mean, it would be like if you were a massage therapist, be like, hey, can you give me a 2-hour full body today? I'm like, I mean, you can pay me. Like,
what about 100-hour full body over the next 4 weeks? Can you do that?
Right. It's just like, you can pay me. Like,
and also it's actually a lot worse than that, because it's like then you get up off the massage table after those 100 hours and you're 10 times richer.
right.
Because it's investment research.
Right.
So it puts money in your pocket as well. But anyway, look.
Yeah, go ahead.
If people can get something for free, they're going to try and get it for free.
Of course.
I mean, that's the world we live in. But there's a value to the work, as you said. Obviously, this is fundamental deep dive research I do myself. So
and I highly respect the work you do. So
thanks, man.
Yeah.
Yeah. So okay, let's set the scene. So this stock is, look, I'm trying not to be too overly bullish. What I would say at the outset is I've never seen an opportunity like this, right? I think in the pantheon of opportunities I've seen, maybe GAN is in there, but this to me is far more exciting. And the reason it's far more exciting is if you go back and listen to our podcast again, whoever's listening on GAN, you'll note that I was a little, when we were talking about the risks and the worries, I was not 100% convinced of their technology platform. That is, there were some competitive issues there, right? I was not 100% all fully convinced that they could, there was the FanDuel concentration issue. Right. And then there's some obvious issues around, okay, well, what do they have a proper moat with what they're doing, right, in the customer wallet? And some of those have not been proven out. So, my skepticism was unfounded, but those nevertheless remained. Whereas Endor, when we come to talk about it, I kind of believe they have a much, much stronger competitive position in their core market today. And that market is equally nascent, equally immature to the online gaming market, online gambling market in the US. So that's kind of what attracted me first to this story. But to kind of set the scene more broadly, Endor is a German company. It's a small cap. Market cap today is about 200 and something million euro. It's listed on the Munich Stock Exchange. So this isn't the main German exchange. That's the Frankfurt Stock Exchange. So it's kind of like the junior market.
Is this kind of like the AIM market for London, the equivalent of for Germany?
Kind of, but not as bad. Not as bad.
That was bad.
The AIM market in London, trading the stocks is extremely difficult because you can't just lift offers. There's an auction system. So this one, there is a normal bid and offer. Okay. It's just illiquid. So look, it's not the easiest stock to trade in the world. It's listed in Germany. It's a bit illiquid. Right now, it trades around $500,000 a day. So not too bad, but not easy.
Yeah.
It's gone up a lot in the last month. Like a month ago, it was like 55 euro, and now it's about 110, 115 euro. So it's moved. But I'll tell about what, I'll explain why I'm not too worried about that in terms of the 1 or 2 year story. So they have Endor is the holding company. They have one operating company, one main business, and that's called Fanatec. Fanatec, their entire business is making sim racing hardware. Sim racing is basically where you get on your PlayStation or your Xbox or your PC and you engage in a virtual online race, F1 or Rally Car or World Rally Championship or Nascar, and you do it over the internet against other virtual racers. So they make, the steering wheel, the racing wheel. They make the pedals. They make the shifters, the gear shift. They make the seats as well. So if you're into this sim racing world, they make a lot of the peripheral hardware that governs the experience. And this isn't like making headsets or earphones for the iPod, right? So when I talk about the steering wheel, you can go to their website fanatec.com and check out the gear. These things are almost exact replicas of like the F1 racing wheel with all the exact same knobs and buttons. And they have a technology that's called force feedback. And by the way, this is not necessarily unique to Fanatec, but it's part of the sim racing world. Force feedback is where while you're racing, every single bump, you go over a bump on the track, you bump another car, the wheel shakes, the pedals shake. Like you feel, it's like when you go to the arcade. If you go to remember racing at an arcade, whenever you bump someone else in the race, you actually feel the impact.
Yeah.
And when you take if you're doing a chicane or a tight corner on a race, and you take the corner wrong and the wheel jags against you and the car tries to fishtail, you feel that through the steering wheel. So it's very immersive. It's a very high-end product, right? And this stuff starts at like 300-400 euro for a wheel, but these fully integrated sets that include the pedals, the shifters, these things can go up to thousands of euros for the set. So it's a very high-end product actually. So basically these guys completely dominate the high-end market for peripherals, for hardware peripherals for sim racing. They have about an 80% market share at the high end, defined as say kits over €1,000. And a much lower share of the low end. So starter level kits under, say, 200, 250 euro, they have a much lower share, maybe a single digit share. And there's a few other companies that compete with them. The main one in the low end is called Logitech, which you probably heard of. I mean,
of course,
they do a lot of other peripherals, headsets, keyboards, whatever, and they also have a sim racing hardware business. And there's a small French company called Thrustmaster, which is also listed, owned by a holding company in France that makes pedals, primarily pedals, but also other gear. And there's a couple other companies. But essentially, Fanatec dominates the market at the high end. And the reason they dominate the market is because they were the first mover. So they essentially were founded in the late 90s by this German guy. And, within a few years, they quickly gravitated towards focusing only on steering wheels for gaming, right? So they're one of the first gaming steering wheels. They produced it. And so they have a very long lead in the steering wheel category in particular. And so over time, in order to entrench themselves in this market, they signed a lot of exclusive deals with key OEM brands, right? So, as early as the early 2010s, they signed an exclusive deal with Porsche. Then they added BMW. Then they added Mercedes. Now, more recently, they've added F1, World Rally Championship, and Nascar. So essentially, all the main organizations and OEMs that are involved in the racing world have partnered with Fanatec over time, which, it's a bit of a virtuous cycle. It lends a lot of credibility to the Fanatec brand. All these mainstream racers, guys in the F1, whatever, they're using Fanatec gear for their virtual races. And at the same time, if you want a Mercedes-Benz wheel that actually looks and feels exactly like the F1 Mercedes car's wheel, you have to go to Fanatec, right? In fact, the only one they don't have of the top brands is Ferrari, and Ferrari's with one of their competitors, Thrustmaster. But other than Ferrari, basically, they're all with Fanatec. So they have a very strong position within this niche. So I guess the real question is, how fast is the niche growing, right? So that's what makes this interesting. So forget coronavirus, before 2020, this business compounded revenues at 40% a year for 10 years. So last year, for example, they grew revenues at 70%. And so, last year revenues were just under 40 million euro, and then coronavirus happened. Actually, sorry, I missed one part. So in January this year, revenues were growing 60% year on year again in January, before coronavirus. But then coronavirus happened. And what happened with coronavirus? Obviously, the sports world stopped, but the virtual racing world took over. And so what you saw is, obviously, people were stuck at home. Video gaming has gone up a lot. Gambling has gone up a lot. We talked about that. But virtual racing took off because all these real races got suspended and all the real drivers started doing virtual racing as something to do. So then they engaged in all these virtual F1 races, and then these other celebrities, sports celebrities, started getting involved. So you see on the Instagram of like famous soccer players, like all these famous soccer players and basketball players in Europe are doing these F1 virtual races in their spare time. And it's all free marketing. They're all using Fanatec gear. Why? Because Fanatec makes the best gear. So, if you look at, say, and this is something I detail in my article, but if you look at, say, Google searches, engagement, native checking of Fanatec.com, the Fanatec brand searches, these all exploded from March. Yeah. And, if you look on Instagram, like half these French celebrities are doing virtual racing, every other day, right? So there's just been an explosion of interest in the sport. And so this was already, if you think about esports, was already growing at, say, strong mid double digits. Within that, virtual racing, sim racing is a pretty meaningful competitor. And this company was already massively outgrowing the market. As I said, they compounded 40% CAGR and 70% last year when Thrustmaster, their main competitor, barely grew. So they've been taking share as well. But then you had this kerosene on the bonfire effect of coronavirus. And so very recently, the CEO came out and said in a post on Fanatec.com, so not to the investor world, but to the fans, Fanatec.com has a big fan forum, right? Okay. He came out and he basically said, look, we're really sorry. We haven't been handling customer orders quickly. We've been taking 2 weeks to reply to emails because demand is 5 times higher than what it was in January, which was already 60% higher year over year. Now, look, there's a downside to this, right? Obviously, there's a huge execution problem because they just aren't staffed for the demand. But the underlying point is, this business is just absolutely exploding. So on the one hand, you have this temporary phenomenon. On the other hand, they also came out and said, look, the underlying trend in the business is now so strong. Excuse me, they didn't come out. A German finance magazine came out, which had done an interview with the CEO. So, it's kind of like the message is from the company in a way.
Mm-hmm.
They came out and said, look, this business is going to do 80 million euro in rev this year. And so last year they did 40 million. So that's doubling in a year. And we think it's easily going to do 100 million next year. So even on a normalized basis, growth is still going to be, 30% or whatever. And within 2 to 3 years, we think it'll be 150 to 200 million revenue business. And here's the kicker, at 25 to 30% EBIT margins, right? So look, I mean, the valuation of the company, and by the way, the company has no debt. So the valuation of the companies today is a bit over 200 million euros. So you're saying you're paying 1 times revenue out a couple of years, maybe, or even say 2 times revenue next year for a company that's already doing 15% operating margins, where margins it's a hardware business where they outsource manufacturing and they distribute entirely through their own online store. There's no distribution to physical retail. There's no third party, margin take. And the gross margin of the product today is 50%, right? So obviously it is a huge fixed cost business, which should see a huge increase in operating leverage as revenue scales. So frankly, on my numbers, before that new information came out from that German magazine, which happened, a week ago or 2 weeks ago, on my numbers, I thought it was trading on, mid-teens earnings next year. Mm-hmm. So basically, after doubling, I thought it was trading on 6 or 7 times earnings a month ago, despite growing 100%, which is kind of crazy. So now it's trading on, it was trading on, 13, 14 times. But then I had to take my numbers up again massively because essentially demand is even higher than I thought. And they're speculating that the growth is just going to continue to be higher than I was even expecting, a normalization in the second half of the year and next year, which seems like is unlikely to happen soon. So basically, where the stock is today, I think it's trading not far north of 10 times earnings, maybe 11 times net earnings on next year's numbers for a company that I see no reason why it couldn't continue to grow at, 25, 30% a year for the medium term. Like if we think about the size of the market, right? So the global video game market, okay, so we have to segment it a little, I guess, but basically the console game market is about 55 billion a year, okay? The downloadable PC market is about 35 billion a year. So let's call it 80, 90 billion. Now, of the console market, racing today is, I think, only 6 or 7%, maybe 6%. So it's not a large portion, right? A lot of it's, 3D shooters or whatever. So racing's only 6%. So today, racing spend of consoles, maybe call it 2-3 billion, and then another, let's say, a few billion of the package market.
Yeah.
Well, okay, so that means Fanatec's total revenue right now is about 80 million euro. And, let's say the average customer spends 1,000 euro on their wheel. Actually, it's probably, when you complete the whole set, maybe it's more than 1,000 euro. But just for ease of numbers, that's 75,000, 80,000 orders a year, right?
Yeah.
Right, so and by the way, they do no business in China today.
Okay.
This is just Western Europe, North America, and Australia and Japan, essentially. So very little penetration in the world's biggest video game market. This market is still growing. I mean, natively growing at.
Why, Jeremy? I have a question. Why are they not doing business in China right now?
They just hadn't. I mean, so first of all, the virtual racing market is in its infancy, right? So it's really only taken off in the last few years, and then in very developed markets, meaning Western Europe and North America, and then more recently a little bit in Japan, a little bit in Australia. But essentially, it's been a tiny company, right? They just didn't have the resources. So it's a German company based near Munich, bit of an oddball company, to be fair. They've had their challenges in the past, and look, they're not ready for the big time. Let's be honest. They weren't ready for this explosion in interest. They only publish their press releases in German, right? They don't even publish their financials in English yet. And the disclosure requirements for a company listed on the Munich exchange are pretty low. They still haven't filed their 2019 full annual report yet, so they've only published what the net income was and what the revenues were. They've published the first quarter sales number, but not much more than that. So it's not quite a dark company, but it's definitely not ready for the big time. So there is certainly a disclosure learning curve they have to go through. They have to mature as a company just as business is growing. But, we looking at GAN, I mean, and by the way, none of the investment thesis is this company is going to be listed on the Nasdaq and it's going to That's not the thesis, right? If this was listed on the Nasdaq, the stock would be up 10 times. It would be 5 to 10 times higher than where it is today. I have no doubt in that, because I mean, how many companies can you point out that grow at 100% a year and trade at 10 times earnings? I mean, there's just none, right? So that's not the thesis here. The thesis here is this is an extremely well-positioned company in an extremely fast-growing market that was growing very quickly before COVID, but is now growing faster post-COVID. And there's no reason to think they couldn't continue to dominate the niche with a business model that lends itself to a huge operating leverage.
What is your view on this not just being a fad and it going away, this virtual racing stuff?
Yeah, so I mean, a few things. Firstly, the very long-term growth trend before COVID. So we have to distinguish between what's the COVID-related bump and what was before. So in this regard, the commentary all through 2019 was, and obviously the performance in 2019 was great, right? So in 2019, revenues grew 70%. They put up 40 million, maybe slightly more than that actually. And they saw margins expand from low single digits to, I think, low double digit at the operating level. So basically 10-point margin expansion. So basically the business proved itself last year. Then, as I mentioned before, the business is growing 60% in January. And the company, in that note I mentioned, the company was budgeting for 60% growth this year. And they were equipped to deal with 60% growth. And then they got 100% growth in March, and now almost 200% growth in April, May, or whatever. So, yeah, you're right. If COVID goes away, this is just going to be a business growing at, long-term 30%, and this year maybe 60%, driven by this increasing interest in esports. I mean, esports itself is a buying trend, and then within esports, it's sim, it's virtual racing. Which, think about it, if you're playing esports and you're playing Madden, right, or you're playing FIFA, those are great, but you're still playing a video game.
Yeah.
But if you're playing esports and you're racing a car, you're actually racing a car. It's the closest, most realistic, most immersive.
So you think we're just in the infancy of this kind of technology?
I mean, look, you're obviously going to see the price points come down, right?
Yeah.
It's too expensive. Not everyone can afford to spend €1,000 on this hobby. But as I said, they only need 80 to 100,000 customers a year at current run rate. And the installed base of racing games globally, according to fandom.com, is 500 million games.
Interesting.
The installed base of Gran Turismo games alone is 10 million, apparently.
Okay.
So you don't need every single person to want to spend €1,000. You only need to see you need to see increasing global interest in the concept in esports and in racing, which is obviously happening. And then you just need to see premiumization as you go along. People can come in and start with the €100, $100 Logitech wheel, whatever, and then over time, if you have better gear, you perform better. It's just like lacing up the best Nikes versus me running around the track barefoot, right? Like if you have the best Fanatec wheel,
I get it. What prevents a company, say like Sony or Nintendo, to get into this market and just steal all this away from Endor?
So Sony is actually they're a partner in a way, right? So obviously the PlayStation is one of the main platforms, and a lot of the games are going to be released on PlayStation. So they have a contract with PlayStation, just as that they have a contract with the OEMs to produce the gear that's compatible with PlayStation. So PlayStation actually is more of a partner than a competitor. If you look at
but they won't do it. I mean, what if they decide, we just want to do this ourselves? We'll just make our own gear. That's what I'm asking.
I guess there's two things. Obviously, there's the brand. So at this point, the Fanatec brand has been built for over 2 decades. So this is a branded product. And Ferrari is the wrong comp, but this is a very high-end luxury type product. That's why they can charge 50% gross margin. That's point one.
Okay.
Point two is the pond is just not that big. Like PlayStation, whatever their annual revenues are, I could look it up. It's in the billions, right? We're still talking all the Fanatec's revenues on an annual basis are still €80 million.
Right.
So even if PlayStation wanted to enter the market, even if they thought they could take a third of Fanatec's business over X period of time, we're talking 100 million annual revenue or something.
Yeah.
We're not talking, doesn't move the needle for them. And obviously it's quite different, right? So PlayStation, it's a typical razor blade model, right? They want to increase the installed base as much as possible of the console and then make a recurring profit on game subscriptions.
Sure.
Or sales.
I remember, years back, right? You know, we had like, do you remember Duck Hunt on Nintendo?
Yeah.
And do you remember how Nintendo made like their own gun? You know, little thing. So that's just why I'm thinking like that.
It's more of a risk, I think, is you see some of these other guys like Logitech try to throw a lot of money at it and see commoditization of the product rather than a new entrant, to me. But even that, I'm really not worried about. I actually think it's far more likely Logitech's a $11-12 billion company, right?
Yeah, they're huge.
Just turn around and buy this thing. I mean, so this thing's growing 100% a year. The CEO still owns 40%. That's the other thing. The CEO and founder still owns 40% and said he's not sold a single share.
Okay.
So look, maybe he doesn't want to sell. He probably doesn't want to sell now. But if Logitech comes in and pays a crazy price, that seems far more likely to me than someone investing money to try to get up to speed, because their position is just extremely strong.
No, fair point. It makes sense.
Yeah. I mean, I think the bigger risks with this investment, honestly, there's two risks. I mean, one is obviously execution. So they have a very loyal customer base, as we've kind of touched on, given the strength of the brand. But, you know, if you can't deliver their product and you know, if you're just incompetent as a business servicing them, then at some point they're going to get upset. So they really need to get up the learning curve in terms of servicing their customers. I'm confident that's something they will do, but, you know, obviously they need to invest a lot of money through the P&L in hiring people, developing a better ERP system, things like that. So, you know, there will be some lumpiness in the P&L. That's to be expected. The second risk is more of a liquidity / trading risk. Like, if you put this away and come back in 5 years, I'm very confident you'll do extremely well. But like what happened with GAN, right, during the crisis, it's still a microcap stock. It's still listed on a weird exchange. There's still a bunch of retail German investors who, you know, their stock's gone from 50 to 100, 110.
Sure.
If the market was up tomorrow, could easily go back to 50. I don't think it would happen because, you know, there's more professionals looking at it now, but it could go from 100 to 70 in a heartbeat. That could easily happen. Yeah. So it's more of a liquidity /
I mean, with a company like this, it could go from 100 to 50 again.
Yeah, I mean, it could happen. Look at what GAN, right? Yeah, it doesn't take a huge number of sellers to push even a great
GAN
story.
went from like the low 200s or high 100s to like 68.
Exactly,
like
and that
week.
Was one day, one print. Was I remember trying to buy shares there and I couldn't, and the next day it was at 90 or whatever. But it happened. So you're right. I mean, that's more of a risk to me with a story like this than the actual fundamental picture. Look, it's very difficult to see how the trend changes unless they really shoot themselves in the foot on the execution
I think you
side.
made a good argument for that.
Which is a risk. So those are the kind of things I'm focused on. And yeah, I mean, look, I'm trying not to be too outright bullish, but it's just really exciting. Like, how many times in your life you're going to find something sustainably growing at, I mean, forget 100%. Let's just say 30%. It could compound at 30% easily for the next 4 years.
What percentage of your portfolio did you make this?
I mean, it's my largest position. I want to keep that the exact percent to myself, but I run a concentrated book and it's my largest position. Okay. So, and by the way, I bought all the way up. So, you know, I bought some at 55, I bought some at 85, I bought some at 105. So, the only thing limiting me from getting bigger is basically my own risk management, right? Mm-hmm. And, you know, the stuff we talked about with regard to execution, but more the whole liquidity of the stock is a bit of an issue. So, yeah, so I really love this. I mean, you know, it's always caveat emptor, right? Do your own due diligence. And for this name, it's harder than most given the language barrier and that what I've said. But, you know, hopefully this will be a good starting point for some of your listeners to kind of learn about the story. It's super exciting as well. Look, I think there'll be more of these kind of names. I mean, forget bringing this name to the NASDAQ. If they just bumped it up to the Frankfurt exchange, the stock would probably double or triple. So, but that aside, I'm not budgeting any of that. You know, I kind of think even if they do little things, like I do think they will publish English press releases and English financials. I think that's just
inevitable at this point.
Yeah, I mean, look, it's already up to a small cap company, right? Like that probably happens this year, I think. And so that's one thing for more eyeballs. And then obviously people like me talking about it, other investors already talking on Twitter actively about it. So it's going to get out there. And then there'll be a lot of pressure for them to just sharpen their investor relations image. And, you know, that has a positive impact.
Right.
But I think there'll be more stories like this, though, because the whole market is, you know, as you saw with online gaming and gambling, starved for growth. And so this is a this is a what's the word I'm looking for? This is a quintessential structural growth story at a, for now, value-ish price. So that weighs all the other risks to me we talked about.
Well, cool. This was interesting. I don't have any more questions for you. You lay out a good job at sharing your thesis.
Thanks. Yeah, so anyone who's more interested, they can obviously go to my site, rapercapital.com, and check that out. And if it makes sense, they can sign up and see all the numbers.
We will put a link to that for sure on the notes. And
thanks, buddy.
You can go to ericschleien.com/podcast for all the notes and for all of Jeremy's former episodes that we've done. Any other last words before we go?
That's it. That's it for today.
All right, man. Well, it was good catching up like always, and maybe we'll chat in a few months.
Sounds great, mate.
All right, take it easy. Bye.